Okay, so let's get right into it. For what, decades, the rules of investing have been pretty straightforward. But something big is happening right now, a huge shift. The very foundation of what we consider a safe portfolio, well, it's starting to crack. And that's forcing what we're calling the Great Realignment of capital. We're going to break down exactly why this is happening, and maybe more importantly, where all that money is headed next.
And this quote, wow, it really says it all. This comes from BlackRock, the biggest asset manager on the planet. So when they come out and say that government bonds, the traditional safety net for every investor, aren't a reliable cushion anymore, you better believe the entire financial world sits up and pays attention. So, what exactly broke?
Here's how we're going to unpack this whole thing in 5 parts. First, we'll look at the problem itself, why that old safety net of bonds is failing. Then, we're going to follow the money, see where it's actually going instead. That's going to lead us straight into the central debate around crypto. Is it the new digital gold, or is it just another risky tech stock? And finally, we'll put all the pieces together to really understand what this great realignment means for the future of investing.
All right, part 1, the broken ballast. Let's dive into why the old rulebook for building a portfolio is basically being thrown out the window.
So here is the absolute crux of the issue. The whole job of a government bond has changed. It used to be your ultimate portfolio cushion. It was simple, right? When your stocks went down, your bonds usually went up. They were hedged. But now? Well, BlackRock is pointing out that because of massive government deficits and these sudden policy shocks, bonds can actually become a second source of risk. Think about that. Instead of balancing out your stock market losses, they can fall right alongside them. The reliable hedge, it's just not so reliable anymore. And this breakdown of the classic 60-40 portfolio, it raises a massive question. If the safe part of your portfolio is no longer safe, where do trillions and trillions of dollars go to find some shelter and hopefully some growth?
And that leads us right into part 2, capital in motion. With the old playbook in doubt, investors aren't just sitting on their hands. Nope, they're actively searching for new pillars to build their portfolios on.
And this isn't just about one thing. Capital is flowing into a bunch of different areas. We're seeing huge investments in infrastructure, things like the AI build-out and the green energy transition. A lot of money is also moving into what's called private credit, which is basically chasing higher yields by lending directly to companies. Even within the world of bonds, investors are getting way more picky. And of course, a pretty significant slice of that capital is now rotating into the world of digital assets. And that brings us to our next big topic. Part 3, the digital gold narrative. This is the bull case. This is the argument that Bitcoin, especially, is ready to step into that role that bonds and gold used to play, as that key diversifier and hedge against all the uncertainty in the world. Now just take a second to look at the sheer scale of this. We are not talking about some niche little asset anymore. By December of 2025, US spot Bitcoin ETFs held a staggering $122 billion. That number, it represents a tidal wave of institutional money that's now treating Bitcoin as a legitimate, serious part of a modern portfolio. And the speed of this adoption, it's just mind-blowing. Look at this. BlackRock's Bitcoin ETF, IBIT, hit $95 billion in assets in just over a year. The fastest-growing gold ETF, it took more than double that time to hit the same milestone. This isn't a trickle of money coming in. It's an absolute flood. So what's the logic here? Why the big rush? It really comes down to one word: diversification. This chart shows you exactly why. Historically, since 2011, Bitcoin has shown a really low correlation to traditional assets. What that means is it basically dances to its own beat. And for a big institution that's looking for a true diversifier now that bonds are acting weird, well, this is exactly the kind of data that gets them excited.
But, and this is a really big but, it is not that simple. And that brings us to part 4, the counter-argument, that Bitcoin is actually behaving more like a high beta tech stock. Now, in simple terms, high beta just means it's extra sensitive to market swings. So this is the bear case, that Bitcoin isn't a safe haven at all, it's actually a source of amplified risk.
Which brings us to a critical question. That long-term historical data looks great, right? But does it actually reflect what's happening in the market today? After all that institutional money has piled in.
And boom, the recent data is, well, it's a shock to the system. In January 2026, Bitcoin's correlation to equities suddenly shot up to 0.75. That is incredibly high. A correlation of 1 means they move perfectly together, so 0.75, that's practically in lockstep.
So instead of acting like a hedge, it was behaving like a super risky tech stock. This right here is the core of crypto's identity crisis. And get this confusion goes right to the very top. Listen to this quote from Robbie Mitchnick, who literally runs digital asset strategy at BlackRock. He's openly admitting that when news about tariffs hit and stocks sold off, Bitcoin sold off too. And he doesn't really get why, because fundamentally, tariffs shouldn't affect Bitcoin at all. When the people at the heart of this whole movement are admitting they're confused, you know we are in brand new territory.
So what in the world is going on? Well, one powerful theory is something called the reflexivity trap. Think of it like this. These huge institutions come into the market and their trading algorithms are programmed to treat Bitcoin like a risky tech stock. So when the stock market dips, the algorithms automatically sell Bitcoin too. And that very action creates the correlation they were expecting, which then just reinforces the strategy. It becomes a self-fulfilling prophecy, where the price is moving because of market mechanics, not its own fundamentals.
So we're left with this deep contradiction. Two completely different stories. How can both of them be true at the same time? Well, that brings us to our final section, the Great Alignment, where we're going to try to synthesize these two conflicting identities into a new, more nuanced way of looking at things.
Maybe the answer is that Bitcoin doesn't have just one single identity yet. Maybe it's better to think of it as having 4 potential futures. It could evolve into a true sovereign asset, something held by nations in the reserves. It might just settle in as a permanent risk asset, that high beta tech stock we talked about. It could still mature into the inflation hedge everyone hoped for, finally becoming digital gold. Or its value could end up being tied to its use as a utility network, driven by real activity happening on the blockchain itself.
The good news is, we don't just have to guess which path it's taking. We can actually watch the data. Keep an eye on its correlation to stocks. If that number drops below 0.5, that's a sign it's acting like a hedge again. Watch for any government adoption announcements. Compare on-chain transaction volume to price to see if the fundamentals are finally taking over. And track things like real-world asset tokenization and stablecoin volume to see if it's gaining real-world utility. These are going to be the signposts for its future.
So here's the key takeaway from all this. This identity crisis, it isn't a bug. It's a feature of its growth. The real conclusion isn't about what Bitcoin is today, but what it is actively becoming. This is an asset class being forged and reshaped in real time by the very institutional forces that are now a core part of its ecosystem.
Which leaves us with one final big question for you. We started this whole thing with the idea that confidence in bonds is breaking down. So as that trend continues, do you think that could provide the fuel for the next big crypto rally, finally pushing it to become that true alternative asset? Or will its tight link to the stock market hold it back? That right there is the billion-dollar question for the road ahead.